the Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is a California attorney and CPA. He practices in the areas of taxation, real estate planning, financial problem resolutions, and 1031 exchanges. He's a certified specialist in taxation law, California State Bar Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. In his past life, Scott worked with Price Waterhouse. He was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. Made his papa very proud. Anyway, in an even previous life, he was a sports writer. He covered Major League Baseball, National Football League, and other sports. But I don't think he was making as much money as he is now.
No, certainly not.
Anyway, today Scott and I are going to talk about some new rules that the IRS has issued related to business deductions for repairs and the requirements to capitalize certain costs. And it seems like kind of a heavy, unusual topic. We'll get into that a little bit, but basically I think it's important that our viewers, especially if you have a business or you're investing in real estate, that you know about this stuff. I'm going to give you a caution. This is a very complex subject. We are just going to scratch the surface. The regulations are very thick. I say that they're staggering. So we're just going to hit some highlights. And this means, I guess, in a sense, our number one message is get help. This stuff, you can't just handle this on TurboTax by yourself. Not for 2014, folks. You're going to need to get help this year. All right, Scott. Well, I know that you're grimacing a little bit here too.
Well, I think that's a very important point before we dive into the minutiae here.
Yeah.
In my practice, we from time to time get the TurboTax kind of people, and I say, I sort of, in the right circumstances, I encourage someone to graduate to a paid preparer or a paid advisor. But some people have a simple situation and so forth. The interesting thing about a TurboTax situation, which is a fine product, it's a practice aid, just like the software that you or I would use in a professional setting. Is that it does a lot of things for you. It helps you add figures correctly or deduct or follow the forms correctly in a lot of ways. But the overall admonition, whether it's this topic or just any topic, is garbage in, garbage out. And so I just can relate many stories about how people have made they've decided that they didn't like the outcome on a certain type of thing from their software, and they've overridden it, or they've done things to get to where they want to be, even though it's not necessarily correct, or they've completely missed an issue altogether, like what we're going to talk about today, and that kind of thing. So just be careful. Just be very careful.
Yeah. So anyway, with that, why is it important, Scott, for every business owner and investor in rental real estate to be aware of that these regulations have been issued by the IRS about repairs and capitalization?
Well, the main thing is that there are certain elections available to us, and there are certain treatments that have to be followed in the regulations. And there's a sort of an old expression: is as long as you don't get audited, you can pretty much send anything in that that's reasonably acceptable. Which is not, believe me, I don't espouse that. But if one were to file returns and ignore these rules or just sort of blow them off, and then later get audited, the IRS, of course, has the power to come back and say, hey, you should have followed these rules. You should have observed this. In this particular transaction, you should have done this, you should have done that, and therefore we'll come back and adjust your tax return. Adjust, and it could end up being additional tax liabilities, penalties on those, and of course interest and so forth and so on. Not to mention all the uncertainty and the fright that an IRS audit tends to give us.
Right. And also related to this, I mean, as we're going to discuss here, we're going to highlight a few of the key elections. And if you don't make the election, then you won't qualify to get the benefit of the election.
Right,
And so, so that's another reason why. Another thing, though, is part of what's in these regulations, what they require, is to actually, in some cases, to restate some things that you may have done in the past. In a
Right.
way, it may be to your advantage to do so.
Right, right.
But anyway, so if you don't, then again, you're at the mercy of the IRS about how those are going to be picked up.
Well, and I think that's a good point. The restatement of the prior treatments is available to us now for this limited time only sort of thing. And as you say, it could be advantageous. And you may come to discover, if you don't do these things, you may come to discover, darn it, I wish I had done them. It's
Right.
not so much that you get in trouble, it's that you lose a benefit
Right.
of doing them.
So when did these even come out?
So the regs were issued in September of 2013.
Uh-huh.
And they're effective for most of us for 2014, so for this upcoming tax year.
Right, right. And there's also, related to this, we're not just talking about filing an income tax return here. So,
Yeah, so in the treatment of the, we were talking about some of these prior methods. These are under the broad category of change of accounting method. And an accounting method is sort of fundamental and integral to the way that a taxpayer reports his or her income. For most 1040 taxpayers, they're on something called a cash basis method of accounting. And then from there, it can branch out into how you account for things like acquisition of a piece of equipment, or money spent for repair or a betterment, and so forth. All those are accounting issues which are used to compute taxable income, which then, of course, derives your tax liability for that year, or future years for that matter.
right. And so I haven't heard of change of accounting forms being required for such a broad group before.
It is interesting. Up to this point, the most popular thing in real estate has been the so-called cost segregation, where someone can go out and acquire a property, and let's say, for example, they buy an apartment building, and in the general sort of simplistic way to look at it is you allocate a certain portion of the price to land and a certain portion to the building, and then you write the building off on a depreciation over 27 and a half years if it's a residential rental property. And then there are those practitioners out there specializing in this idea that the building isn't just a building, that it's comprised of many separate components, some of which have a different accounting depreciable life than 27 and a half years. So they might, some fixtures in the building might be 5 years or 10 years, and by doing this cost segregation approach is a different method of accounting, accelerates deductions, can in fact reduce tax liability in the early years and be of great value for some of these larger purchases.
Right.
So that's typically where you see it in the real estate environment. And now, of course, we get these regulations, and you might
Right.
see
And
it
this
more.
is something that's, I mean, virtually everybody is supposed to file a change of accounting for. I'm just visualizing the forests vanishing because of all the
Yeah.
paper that's supposed to be used for this thing.
Correct.
If the IRS gets its wish.
Yes.
What does capitalized mean?
Well, that's pretty fundamental to accounting itself, whether it's tax accounting or financial accounting. As lay people, we have money, and we buy something, and sometimes what we buy is consumed in a short period of time. So, for example, I buy water from the water company, and we, shower with it, and we wash our dishes, and we drink it, and so forth. That's sort of an expenditure that's related right now. It's here today, gone tomorrow, kind of thing. That's an expense, and so so if that's in a business environment, we can write that off immediately. Now, by contrast, some items are longer lived. So, going back to my rental property approach, you don't expect that the rental property is going to last a year. You're paying a lot of money for it. You're expecting it's going to be there for a while. And so, from an accounting perspective, whereas in my business I wrote off the water bill, or I wrote off the electric, or I wrote off some supplies that I might have bought, well, I want to take that building and I can write it off certainly, but I can't do it in 1 year. So I capitalize it. That's putting it on the balance sheet, and little by little, over this concept called depreciation, I deduct it ratably over its lifetime. Now, for the tax code, historically for financial accounting, it's sort of an estimate based on a useful life concept. For the tax code, those are all fixed; those are set based on the type of asset that it is. And residential rental, for example, is 27.5 for the structure only. Land, of course, isn't depreciated.
Right. Okay. So we said the rules are effective. There are some taxpayers, they're effective for 2014. That's this year.
But then those manifestations are with the return, which will be next year.
Right. It means that we'll actually be doing the filing next tax season, which will be during 2015.
Right, and so here's an interesting conundrum, for tax preparers, and of course we both are in that business. I think a lot of our clients, and this would be true of anybody that's that uses a paid preparer with this type of thing, reasonably they should expect to go on extension, because to try to jam all this in the first 3.5 months out of the year, given all the bulge in the work.
Yeah.
And I know, as having done this for over 30 years, and I know you've been in it for a long time, it's not realistic to expect your preparer to be 100% sharp during the worst time of the year. And so give them a little breathing room. And so when they ask you for an extension, say, I get it, I understand it. Understanding that it's just a report and nobody's going to jail to get an extension, and it can be useful. So.
Yeah. But it's another thing. I mean, some people could be preparing for this right now.
That's correct.
They could be sort of looking at their records and what they're doing and whether some of these elections may be to their advantage. Are any of the changes taxpayer friendly?
Oh, I think so. Yeah, some of the rules have liberalized as to the expenditures, and as you mentioned earlier, some of the changes of accounting methods could be favorable to either shorten lives or deduct something more currently on this change of accounting method that you mentioned.
Okay, so one area I want to talk about for a moment, it's going to impact almost all businesses, is materials and supplies.
Right.
So maybe you could talk a little bit about that for a few minutes.
Again, materials are, it's usually a period item, meaning that you spend it now, you write it off now. A lot of taxpayers are, in fact, cash basis. Some are accrual, which means they deduct at the time they actually acquire it by getting trade credit and that type of thing. But these rules tighten up what is a material and a supply as far as that goes.
Yeah. So, one of the things in the past is we didn't have anything in the Internal Revenue Code or even in the regulations as far as guidelines for writing off small items. So theoretically, if you had a long life asset, let's say a stapler or a calculator, okay, you were supposed to depreciate those items. Many of us would make expense elections to write them off.
Which has been with us, actually. That's called 179 typically.
Right.
That's been with us for a long time.
Right. But now we've got some guidelines that are outside of 179, and so we're actually able to write off some of these small items. There's a guideline that's sort of a general one of $200 or less, but if you make certain accounting elections and adopt it as an accounting procedure, for the people who don't have audited financial statements, $500.
Right.
And that's for an item. So
Right.
think about it. There's some, you could buy a Dell computer. No, you and I probably wouldn't buy one like this, but I bought one for my home for less than $500.
Correct.
And pretty nice computer.
Right. Right.
So anyway, and you could write the thing off.
Right.
And now we talk about these tablets, right? And they're a couple $100.
Right.
So, and you could buy several of them for your business, and there are applications for those these days.
Although, in fairness, the old 179 rule is was intended also to pick those up. So it's conceivable you could see these as sort of duplicative in a sense.
Maybe, and also the thing, again, we talked about things like, what if you didn't make elections or what have you? You still have that as a backstop.
That's true,
you can
and
use
you
it
do
once
have
in
to
a
you do have to make an express election to take that approach.
Right.
Although on the other hand, now here's something interesting. On the other hand, sometimes we have these small businesses, especially newer proprietorships. And it's actually disadvantageous to take all of the expenditure in the first year. They might want to write it off over multiple years, just because their income is
expected to go up later.
going to go up later,
Yeah.
and so that could be detrimental. And we're talking $500. I mean, again, you get down to the minutia.
Yeah, but when you add all these items up, though, it can add up to a lot more than $500.
I hear you. I hear you.
Anyway, and then even more important is for companies that have audited financial statements.
Mm-hmm. Yeah.
Because they have a much higher threshold.
Right, and hopefully, this presentation, this program, is not directed to them, because if they got audited financials, then they got an accountant.
Well, of course, but nonetheless, well, folks, the limit is $5,000 for an item.
Yeah.
So.
Well,
anyway.
so maybe this is like Auditors Full Employment Act.
Well, maybe, yeah, because now suddenly there's a big incentive here for having a financial statement.
Yeah, so if the auditor can convince the client to get an audit, saving all this tax money pays for the auditor's fee.
Yeah. Let's talk for a few minutes. What about repairs for small taxpayers?
The repairs historically have been immediate deduction. And there's been this sort of traditional approach of betterments that lasted more than a year, and those were intended to be capitalized. And now these are liberalized. Mm-hmm. Like I think you had one example here of the foam roof. What was the?
That's a little farther down the way, but that's okay. Yeah. So we have the example that the basic roof may be fine. Suddenly it's developing a few leaks or whatever, and now they're going to reseal it.
Right.
And so they're not tearing off everything that was there before. Now, basically, they're just sort of resealing the roof. And in the past, maybe there would be an argument about whether that had to be capitalized or not.
Right.
We're really into the routine maintenance item. We'll get into more into later. But those can be now deducted. But now even, small items that maybe you would have to capitalize in the past, we have these guidelines where we can, in fact, if you've got a building that's less than $1 million, well, let's say a house, right?
Right, single family or
family residence, so you can take 2% of the unadjusted basis, or $10,000.
Right.
And now you can just do a write-off.
Now let's be clear. It's not your personal home or your vacation home.
Right.
We're talking about a rental property.
We're talking about a rental property.
Correct.
Yes.
Right.
Okay. So this is an annual election.
Right.
So
you can take it either way. Is the whole idea from year to year.
From year to year, you can make this decision. And one thing is this means, as a tax return preparer, you and I need to have a checklist item.
Correct.
That each year we need to look and see, do we need to put that election in there?
So at the risk of breaking the Brotherhood code here, my software probably has a thing that beeps at me when I'm ready to push the button, and it say, "Hey, wait a minute, you got to think about this election." Or so we've all seen these as diagnostics.
Yeah, we got a diagnostic list.
Yeah, and hopefully a TurboTax kind of person, homeowner, individual preparing their own return, hopefully they'd get that list as well. But like I say, I can never be too sure.
Right. Well, and the other thing is, I found, like you said, there are some people that use TurboTax, but they don't use that interview mode that flags all these things. They just try to, fill in the numbers themselves
like
on
a word
the software,
processor, right.
like a word processor. When they're doing that, then it's not going to remind them about things like this.
Correct.
Why don't we talk about routine maintenance for a couple of minutes?
Okay.
So what's happened related to this?
So, for example, the broken window, do you have to capitalize it? Yeah, you might have to in the past. Mm-hmm. But these rules have allowed us to write it off as a repair in the first year. So, plate glass window, a couple $1,000. That's a fairly material item on a let's say a house or a fourplex, because we're talking about individual taxpayers. Mm-hmm. And I think the rationale here is that there's always this argument, is it better because it's new? Well, not necessarily, because it was good enough. And now this replacement is in fact new, but it's not really much better because it's just glass or something along those lines. So I think that the manifestation of this rule is that you didn't really have a betterment. A betterment might be like, okay, we had one bathroom and we just added a bathroom. That's clearly a betterment to the property, which would be capitalized. This is more along the lines of replacing or bringing it back up to status quo is kind of the philosophy.
Right. And so one thing I want to point out to our viewers is a change of accounting method is required related to this. And even though you may have accounted for it correctly in the past, you have to elect that you're going to do a routine maintenance type of accounting procedure. So again, it's something to be aware of. Another thing,
and that's more than just adopting an internal procedure. We talk about adopting these accounting procedures internally for the Dell computer or whatever. That's maybe you have a binder in your shop and you say, okay, this is accounting procedure 1, starting effective now forever. Here's how we're doing it.
Right.
And that can be, if it's sort of, I don't want to say notarized, but somehow memorialized, that can be valid in an IRS audit.
Right. And that is actually what's sort of required for this the $500.
But it can't be done the week before the audit. It has to be really there.
Yeah, no, it was supposed to have been there before, and you're supposed to have followed that procedure. So you have to show that that's how you've always accounted for things.
Correct.
So,
correct.
And that's just something I did, for example, for my business. I put it in my permanent file. I wrote this, accounting procedure, and then now I'm looking. Okay, as I'm paying for things. Okay, I've got an item here. I bought a calculator this year. And maybe it cost me, I don't know, $150 or whatever. Well, in the past, I would have probably capitalized that and maybe take a 179 deduction, the expense election. Now I'm just going to write it off. So, new thing. One thing that I'm concerned about related to this is tires. This stuff is weird, and again, there may be things that people have been doing for years. Where they just been writing off tires as a repair.
Right.
But under these regulations, if you've got tires that cost like more than $500, they probably are supposed to be capitalized. Again, maybe you can make a 179 deduction. I have a towing company, for gosh sake, they spend $20,000 a year on tires.
Right.
And so, so we may get over what the 179 limits even are, but that's something that's sort of up in the air right now, folks. So anyway, we'll see what Congress does related to that. Okay, so let's look a little bit. Improvements that need to be capitalized. So what sort of things still need to be capitalized?
Well, big stuff.
Yeah.
I mean, there's dollar limits are in these rules, but I still think you can drop back on sort of the traditional approaches of the big stuff that is a betterment. I mean, I go back to you added a bathroom to the property. That's going to be a long-term investment, something greater than in 1 year.
Right. So the general rule is just broadly that improvements have to be capitalized if they're betterments, restorations, or adapt the property to a new or different use. So they look, for example, maybe a building was at one time used for a retail store, and now it's being modified to be used as a warehouse.
Right.
Okay, so it's been modified for a new or different use. And so that's going to require expenses related to that to be capitalized.
So this is actually alerting anybody with commercial property about TIs, tenant improvements, because when the lease turns over, and I don't frankly I don't remember what did the rules say about the old TIs. And how if that's been even addressed. But that's one thing to consider is you've got a new 5-year tenant. You kicked out the accountant, and now you got a law firm coming in there, and that new tenant, new TIs, et cetera, et cetera.
Yeah. Let's see here. Okay. Fortunately, we're getting to the end. We don't have time to cover much more in detail related to these improvements, but it does require a change of accounting method. There may be items that you wrote off before that need to be capitalized now. or vice versa. So be aware of that. Just for a moment, I'd like to talk about partial dispositions, because that's something sort of new in these regulations.
Right, right. So again, I mean, this TI idea might be one of the things. You're not really getting rid of the whole building, but you've got this, you've got sort of this renewal, and you had 10 years ago when that lease when commenced, you spent $100,000 on walls and moving things internally, et cetera, et cetera. Then that's what this would address, presumably.
Well, another is, okay, let's say you had a roof, and you got on a commercial building, and now it's 20 years later, and you have to replace the whole thing.
Right, right.
In the past, you couldn't write off the amount that you were capitalizing and depreciating before. So now, because it's part of the whole building, let's say it was there, when you bought the place. So now you can actually figure an amount for that piece and write it off. So this is a new special election.
So sale proceeds zero, and then the
Yeah.
unadjusted, the cost.
Yeah.
And you have to make an allocation and so forth. And then the question is, how do you prove it? You
Yeah.
know? So
Yeah.
what's the value of that? What was the original value? And of course, you didn't think to do that 20 years ago when you bought the place.
Right.
So
in some ways, it may make it cost advantageous to do some sort of a cost segregation study from the beginning.
correct.
For more people. Well, folks, we're about out of time. Scott, maybe you can just throw out a final thought.
Well, again, this is really complicated stuff, and you're either an accountant or you're not, is what I've typically found. So if you're going to try to do this yourself, buckle your safety belts.
Yeah.
But I think this is time for a lot of people to graduate to a paid preparer and address these issues correctly.
Okay. Folks, we're all out of time. I hope we've given you some things to think about and at least alerted you to this issue. We'll see you next time on Financial Insider Weekly.